So who should European investors be hoping will win the US presidential election? Joining me to debate this, Pippa Malmgren, Principalis Asset Management founder and president and former financial market advisor in the White House during the Bush years. And on the other side, Lombard Odier Private Bank CIO Paul Marson. Pippa, let me start with you. If you're in equities, who's going to give you more bang for your buck?
You know, I think the bottom line is that you have to decide where you stand on the repairing of the American debt problem. I think neither one of them is going to do anything that decisive. But relatively, Obama stands for an America that will try to spend its way out of this period of weakness. And Romney stands for an America that will try to earn its way out. So even though you might say, well, earning your way out sounds better for equities, the fact is Romney might be just a little more aggressive about fixing the debt problem, which the equity market might not like in the initial stages.
Paul, can you spend your way out of this? Can anyone spend their way out of this?
Well, to be honest, I think the problem is so fundamental that it doesn't really matter who wins the presidency. If you look at the US federal government, it raises $2.5 trillion a year of revenue. It spends roughly $3.7 trillion on the other side, so a $1.2 trillion gap. Now, the structural, cyclically adjusted primary deficit is about 5 or 6% of GDP. That's a deficit you can't grow out of. You have to cut out of, or you have to raise revenue into. Now, the deficit of 1.2 is equal, interestingly, to the whole of discretionary spending, over half of which is defense. So if you're going to do it from the spending side, you have to slash discretionary spending to zero.
Okay. I mean, bottom line, let's face it, the context here, the cliff, issues in Europe, China, they're both going to be dealing with these issues.
Yeah, but let's understand, neither candidate is going to want to impose a lot of pain on the American public, and the American public don't really understand they owe foreigners any money. So it's not possible for a president to say we have to radically change because we owe foreigners money. So I think you're going to find that the American body politic is going to move forward saying we're not going to introduce austerity. We are instead going to focus on the growth.
Back to my initial question, though. What do you think, Paul, will prompt a larger initial reaction in the market? Obama getting back in or Romney taking it?
To be honest, it's very difficult to know. I mean, if Romney takes it and follows the tax-cutting agenda, the grow your way out, there's really no support empirically for the idea that tax cuts actually stimulate growth or stimulate employment. In fact, if you look at the CRS research that's been done in this field, what you find is that there's no correlation between tax rates and GDP growth, between tax rates and payroll growth. So I don't think there's really much basis for growing your way out of it with tax cuts. So I don't think the market's going to respond terribly well to that. Obama, I think, is probably more of the same. But importantly, you have a split Congress between the Republicans and the Democrats. And so whoever wins is going to have to find a very big compromise between two different parties, which is going to be really very, very difficult.
Yeah, I'd have to say, I disagree with one point here. Look, 2/3 of the net new jobs in the U.S. economy are generated by firms that employ less than 50 people. So the key to our job creation is, in fact, lying with the tax rate for those small entrepreneurs. And that is the core of Romney's argument.
It's not really correct to say that 2/3 of the jobs are created by small businesses. If you look at the US, 27 million, you have 27 million employer firms, 27 million firms, 6 million of which are employer firms. Just over 80% of those are firms with less than 20 employees. If you look at the latest BLS data, between 1992 and 2010, firms with less than 20 employees created 16% of net new jobs. Just shy of 40% were created by firms with more than 500 employees, which make up only 0.3% of firms in the US.
Will we see tightening in 2013?
I think it's likely we will need to see some tightening, because if we don't see it up front in 2013, come 2017, the debt ratio isn't going to be at 104% of GDP, it's going to be significantly beyond that, and the pain becomes worse the more you delay it.
And who's going to be running the Fed then?
Well, we know if Romney wins that he's looking at Greg Mankiw and Glenn Hubbard and Marty Feldstein as an outside chance. If we're looking at Obama, they've been so distracted by this election, they actually don't have their candidate lined up, but they know it won't be reappointing the current chairman. It will be someone new. What I fear, though, is that actually it doesn't matter who you put in over there, they're going to be stuck with this pro-inflation, pro-liquidity policy, because exiting from it is so very difficult.
I would agree with that. I think the exit strategy is so much more difficult than the entry strategy. If you just take up interest rates back to a normal 2%, we estimate that the Fed has to halve the size of its balance sheet, pretty much in one fell swoop.
If a Republican administration makes it, which sectors do you want to get out of straight away?
I have to say, I think you're going to have to be much more narrow and specific. I don't think we're in a period where you make on-off risk decisions in, out of equities, in, out of sectors. I think what you're going to have to take in consideration is costs are rising and the government will impose further costs. So you want to look at who's got margin management capability, and that is worth owning.
Quick word, Paul, on that.
In terms of the US equity market, the market's trading above 24 times trailing 10-year reported earnings, with record profit margins. Now, you know that corporate profits come from a national accounting identity. They come from the deficits accumulated on a sectoral basis across the economy. Yeah. And so if you do get an austerity package, and the US has to tighten at some point by a reasonably large amount, that fiscal policy tightening will, from an accounting perspective, drag profits significantly lower. And that will make the US equity market look very expensive very, very quickly. So I think the outlook for the equity market, regardless again who wins, across the course of a cycle in the US is really comparatively poor.
I'm sure, just to finish up with them, I'm sure you hate predicting these things, but who's your money on?
I generally try to avoid political forecasting. I'm in the camp of Philip Tetlock, who wrote a very wonderful book on political expertise, who really said that political experts can't forecast anything, and I'm not a political expert, and I have even less ability to forecast electoral.
I think the danger is that Romney wins the popular vote and Obama wins the Electoral College, in which case Obama won't have a mandate and the public will feel very uneasy, highly likely, which looks pretty likely right now.
Okay, great. Paul and Pippa, many thanks to both of you. Principalis Asset Management founder and president Pippa Malmgren, and Lombard Odier Private Bank CIO Paul Marson. That's all from us for now. I'm Axel Threlfall. This is Reuters.